Since 2017, the global commitment to AI capital expenditure has reached approximately $2.3 trillion. To put that in perspective, this build-out is unfolding at a scale that mirrors the decade-long fiber optic expansion, but it is attempting to achieve that same physical footprint in a fraction of the time. This velocity is driven by four forces compounding simultaneously. Algorithms are advancing through successive breakthroughs, specialized compute resources are expanding, talent is concentrating in a few key labs, and capital is deploying at a speed previously unseen in technology cycles. For investors, this creates deep, hidden correlations. Because the entire ecosystem relies on the same hardware and energy inputs, a disruption at any single choke point affects portfolios across every asset class simultaneously. Assessing the risk requires looking past software stocks. AI functions as a full-stack capital cycle, and every layer, from the physical infrastructure to the foundational models and end-user applications, is being priced in real time. Determining whether this cycle is sustainable requires checking the physical and societal bottlenecks that reside within each of these three layers. At the base of the stack, data centers are acting as the new industrial factories. This Morgan Stanley analysis defines their output through a single technical metric, tokens per watt. It is a measure of how much intelligence a system can produce for every unit of energy it consumes. Producing those tokens requires specialized silicon, a market defined by extreme concentration. NVIDIA currently holds a 92% market share in the data center GPU segment, creating a singular point of dependency for the entire industry. The supply chain narrows even further at the fabrication stage. Almost every leading AI chip is manufactured by a single foundry, TSMC, making the global hardware stack dependent on a single geographic location in Taiwan. However, the primary bottleneck is migrating away from chips and toward the grid. Reliable, clean electricity has become a strategic asset as the power required to run this infrastructure begins to exceed the available supply. The projections are striking. Power demand from U.S. data centers is expected to double by 2027, eventually reaching a projected 23% annual growth rate through the end of the decade. The infinite demand for digital compute is now testing the physical limits of the global energy grid. If the power cannot be delivered, the infrastructure layer becomes the first point of failure for the entire cycle. Above the hardware sits the model layer. Here, the pursuit of artificial general intelligence has moved beyond a commercial race and is now being treated as a matter of national security. Two architectures are emerging. The US ecosystem is a high-cost innovation engine, while the Chinese model, constrained by chip export controls, has evolved into a low-cost, efficiency-focused system leveraging open-source development. This chart compares language models from both regions. Despite spending less than a fifth of US hyperscalers, Chinese models are benchmarking in line with US peers, helping them gain market share in emerging economies. However, both architectures face a training data crisis. These charts show that the information used to build AI is overwhelmingly skewed toward English, creating an accessibility gap for billions living outside Western contexts. If these data divides persist, the global economy risks splitting into parallel, incompatible AI ecosystems, each siloed by language and geopolitical alignment. At the top of the stack, AI is moving from simple chatbots toward agentic systems. These tools go beyond answering questions. They are designed to use APIs and execute complex digital workflows autonomously. But enterprise adoption is lagging behind the tech. While nearly 90% of organizations are experimenting with AI, only about 7% have successfully deployed it at scale. This creates a monetization gap. The billions spent on infrastructure and models are currently waiting on revenue from enterprise applications that have yet to be fully integrated into daily workflows. As these agents are deployed in sensitive areas like finance and law, they are outstripping the ability of domestic courts to regulate them. Without clear accountability for decisions made by autonomous code, the risks of bias in hiring or lending become a liability for the companies deploying them. This lack of a legal safety net creates a fragile environment for investors. If a high-profile failure erodes public trust, the resulting regulatory friction could stall adoption, making it difficult for the industry to recoup its massive upfront capital costs. The risk of a capital pullback becomes real if the current scaling laws hit a plateau. If adding more compute no longer results in smarter models, the economic justification for the current spending levels disappears. If widespread productivity gains do not show up in the data, the trillions committed to specialized hardware and data centers risk becoming stranded assets, infrastructure built for a demand that never arrived. For companies to survive this cycle, they must move beyond software code. A durable defense now relies on access to proprietary data, deep expertise in mission-critical industries, and established distribution networks that AI-native startups cannot easily bypass. Implementation data shows that the work is lopsided. While algorithms and technical data management are essential, roughly 70% of the total effort must be spent on restructuring processes and retraining people to actually work alongside the technology. Historically, breakthroughs follow the build-out. As this Goldman Sachs and Morgan Stanley research suggests, the specific applications that will eventually justify this $2.3 trillion investment likely haven't been invented yet. Navigating the AI era requires moving past the hype of individual software launches. Success depends on identifying where the next bottleneck will form as this capital cycle moves through the full stack.